starts at the signed LOI phase. For those of you who marked that in the polling question, typically a signed LOI and due diligence period is about 90 days. That is best practice. It is recommended financial due diligence occurs kind of in that beginning piece of due diligence. From there, typically your SBA or bank underwriting process will also begin. So it is important to kind of understand, the 10,000-foot view of what does the due diligence timeline look like and where each of the areas of kind of coverage and diligence take place, when you're doing this process. This is something that I reference often and will show, folks that are getting close to an LOI or about to start diligence. So feel free to, take a screenshot of this and keep it with you. You'll notice also on this things like tax due diligence, legal, and final closing documents. Tax due diligence often can also occur with financial due diligence, depending on the group or firm you go with. Legal due diligence, think M&A lawyers, some of the ones in the ETA and self-funded search space. Happy to give those resources if needed. They go hand in hand with that purchase price documentation. So kind of keep that in mind during this process. So I'd like you to meet Justin. Justin was a former searcher who did the traditional SBA route of buying a business with an SBA 7A loan in the Northern Virginia area. Justin bought his business and he noticed after the transition that it was very project heavy. Construction business, that's the nature of it. Unfortunately, Justin skipped on a quality of earnings and had a very light deal team. He did a lot of DIY financial diligence, legal diligence, etc. He was actually on the Acquiring Minds podcast a few months ago, and it was a powerful story about Justin. Ultimately, his business that he bought, the earnings were not as true, and as the business was not as profitable as perceived before closing. Unfortunately, Justin's business ended up folding up and he had to declare bankruptcy, and the business did close. I had the pleasure of meeting Justin at one of the Georgetown ETA conferences last fall, and he shared this story, which was quite powerful to me. Some of his pitfalls he described were, not doing the financial due diligence piece. The business had some challenges with the accounting. The construction nature of accounting is quite complicated. So they were, there were improper accounting issues which may have been caught in a proper quality of earnings analysis. So I'm in a monthly meeting run by Justin, and he's allowed me to share his story just for those looking to search during the LOI phase. These small to medium-sized businesses have significant risks, which need to be mitigated through proper due diligence. So if we think about that previous slide, stack your deal team accordingly in order to ensure the business you're buying is verifiable, profitable, and you have a clear view of it before you sign that purchase agreement, to avoid, a situation like Justin found himself in. So in this deep dive for financial diligence, we're going to focus on a few key areas. The fundamentals of financial due diligence as it relates to small to medium-sized business acquisitions. There are certain nuances and key areas. I like to bucket them in 5 of financial due diligence analysis you need to conduct to satisfy your requirements of a proper analysis. I'm going to unpack how I assess financial statements and some significant red flags you can spot early on in the process, key risk factors to watch out for in M&A deals, and best practices for ensuring a smooth transition. The 5 buckets of financial diligence are going to be kind of the key areas. Some of these are a little bit more dense than others. So we may have following webinars that do a deep dive just on one topic alone, because a lot of these analyses are very dense. So this is going to be a overview of each piece of the puzzle and how you can best assemble it together. So here are the 5 components of financial due diligence for these small to medium-sized deals. These are things like income statement analysis, quality of earnings review, working capital evaluation, proof of cash, also known as a proof of revenue, and a balance sheet analysis. These are 5 buckets. Within these buckets, there are things like customer analysis, expense analysis, margin analysis on a gross and net level. But when you think about the key check boxes of analysis you must do, these are the 5. So we're going to do some real live deal examples of what these look like. So feel free to kind of jot these down. This recording will be shared after. But these 5 buckets will satisfy financial due diligence. So here's a roadmap of, and if you could just zoom in just a little bit, what the due diligence looks like from start to finish. This is a document I use often where it shows, in a 7-step process, what does the overall process look like. You'll see 1, 2, and 3 are the preparation and planning phases. Think data collection, setting up your engagement, like bringing on a provider, doing a general business review and a meeting of the minds, having the buyers, sellers, and owners speak with one another, establish a plan of action and what that's going to look like, during this due diligence period. It then moves into 4, 5, 6, and 7 is the crux of the analysis. So you'll notice that 6 reads financial statement review. Think income statement review, balance sheet review. These are 2 of the 5 buckets I just shared about what are the 5 components of financial due diligence. Income statement review, think the profit and loss statement of a small company, their QuickBooks file. If you run a monthly income statement or profit and loss statement for the last few years, what are you going to see? You'll see the company's revenue line items by GL account. You will see expenses by GL account. There may be some owner costs involved in there, likely operating expenses, and then, depending on the business, a cost of goods sold line item. You need to understand the story behind what those line items represent. And you need to look for consistent or inconsistent items on a month-to-month basis, and from there ask questions. You do the same analysis on the balance sheet. You look at things like accounts receivable, accounts payable. Does the company have debt? Does the company have other related party transactions on the balance sheet? This document in the balance sheet review, you'll notice there's some key areas to call out. They say, the PPE registers, the asset impairment testing, related party relationships is one I always like to call out. That is easily identifiable on the balance sheet. Things like employee advances, shareholder loans, which are loans the company's owners will give to themselves, or they will loan the company money. They may loan a family member money. That's going to be captured on the balance sheet. So that's why a balance sheet review is kind of critical. From there, double clicking on the technical analysis of what the quality of earnings and financial due diligence looks like, things like a quality of earnings review. That's effectively taking reported EBITDA and proposing certain financial due diligence adjustments to arrive at an adjusted EBITDA. Additional items include net working capital analysis, proof of cash, and net debt, which we'll talk about a little bit later. This slide is an expected timeline of what financial due diligence typically should take. I always include this as a good visual. Boilerplate, all of our quality of earnings typically are done on the 15th business day of a typical transaction. So if you think about this graphic, it's typically by the end of week 3 into week 4 where the reporting begins. We typically have a clear view of what does adjusted EBITDA look like. So this is helpful, for you to keep as you think about a timeline when you are speaking with individuals. So something I like to say with due diligence is trust but verify. What do I mean when I say that? When you are reviewing a sim, speaking with the seller for the first time, it's best practice to trust what they're saying as truth because you don't have enough information. A sim likely is missing the underlying financial information that proves, the revenue and expenses of the company. So when you're in this delicate LOI phase in the beginning or pre-LOI, it's often best to trust but verify. You are going to verify every financial number during the due diligence process that you submitted an LOI for. This trust but verify phrase is something I use quite often because these deals can be messy. They can have some ups and downs, but if you're able to think about this and apply it to, this kind of verification, it's quite helpful. I broke down the due diligence in a different way than the timeline. So this shows kind of financial review. That's what we're covering today. That's financial due diligence. Operational goes hand in hand with financial. Legal review, often conducted by an attorney, but these outstanding legal issues, contracts, and open, maybe pending lawsuits often come up during diligence. Risk assessment is another thing, depending on the business you're pursuing. Things like inventory concerns, there may be management concerns, which is almost an operational risk, and then customer concentration. This is another way I like to think about, due diligence. Next slide, please. So financial statement analysis. If we think about, this is our first key of the big 5. What does this actually mean? Really, financial statement analysis is reviewing the income statement and balance sheets and verifying that they're accurate and consistent based on supporting documentation. So what does that mean? when you're looking at a financial statement, it's kind of important to identify, excuse me a second. It's important to identify the trends and think about what are you looking at when you look at a profit and loss statement, and think about if this makes sense to you. Um, these are kind of just higher level information to think about. And it's often easier to just show kind of like a live example, but just kind of keep these four buckets in mind when we flip to the next slide. We want to go back one. Okay. Thought there was going to be a profit and loss statement. Okay. Can you flip two more ahead? Just want to see what's next. Okay, perfect. There we go. Yeah, so if we think about those last few things, the financial statement analysis, this is what it looks like. So imagine you're under LOI, you've received a company's QuickBooks files, and you get a profit and loss statement. Where do you go from here? I always recommend starting with grouping the buckets by income, cost of goods sold, and expenses. I drew a line in gross margin because this is a quick way you can identify financial discrepancies or things that stick out. So if we zoom in and we look at the gross margin on a year-by-year basis, 21, the company did about 4 million in revenue. From 21 to 23, 4.4 to 4.2. They had gross margins roughly about 70%. At a high level, if you saw things like the gross margin in 1 year went from 70 to 50, that's something you would double click on. So margins are a quick way to identify some potential yellow flags, as I like to call them in deal world, of where you're going to need to double click and ask the owner a few questions. You'll notice the fourth column is January through May, year to date of 2024. Oftentimes you're buying businesses, it'll be somewhere during the year. In this instance, this was a deal that only had 5 months of financials through 2024. The business was trending nicely, but there were some concerns. You'll notice the cost of goods sold was a little bit lower than expected. The reason why I noticed that was all of a sudden their margins are now showing 80%. While you could think this is a good thing, to me, this signals that the company very likely is doing a lot of true ups with costs at year end to get the cost of goods sold to the right number. This is very common in these types of transactions, but the challenge is, especially if you're buying a company based on a few months of financial data in the latest year, you need to understand what the business is doing today. So just understanding those questions and asking, why are all the costs being reflected in these financials in 2024? If we think about where we are today, in 2025, it's very likely the company is still trying to close last year's books. So some of these expenses may not be appropriately recorded. So those are things to think about. If we look down at the total expense line item on row 91, you will notice that expenses increased 28% from 22 to 23. It went from 970,000 to 1.25 million. That is a question you would likely ask the company about, because it appears that they spent, roughly $300,000 more in expenses to generate, you know, similar revenues, a little bit more income, of only, 200,000. So was that due to one-time costs? Was it due to other challenges with the business, increased costs, etc.? Again, doing these quick analysis of percentage increases year over year, margin analysis on a line by line basis is how you properly conduct this financial statement analysis. And really, it's to identify trends and start putting together a list of questions to ask the seller, broker, and their representation. So that's what this kind of roadmap of your initial financial statement analysis looks like during financial due diligence. So balance sheet review. This is the two of the core five analysis you need to do. If we take what we've learned in the income statement review, the approach for the balance sheet analysis is virtually the same approach. What does it look like? You receive a monthly balance sheet over the historical period. In this case, it was 2021 through November 27th, 2024. From there, it's often recommended to do a walkthrough of the balance sheet, identifying big ticket accounts in these small to medium-sized businesses. You're going to spend a lot of time in accounts receivable and a lot of time in accounts payable. The reason why that is because more often than not, if there's any type of working capital involved in the deal, these are going to be the two biggest material items when it comes to determining what working capital looks like. And very often, SMB size deals don't have a lot of balance sheet activity outside of these two accounts. You'll notice in accounts receivable, at November 27th, 24, they had about $1 million in accounts receivable, and the total assets was only 1.7 million. In reality, the balance sheet was only comprised of AR and cash. Very likely, the transaction will be structured on a cash-free, debt-free basis. So understanding the accounts receivable is really the crux of what your balance sheet review looks like. Scrolling down, accounts payable, things like other current liabilities you may see include, credit cards, short-term liabilities, maybe a line of credit, etc. In this case, the accounts payable fluctuated pretty significantly year over year. So you might want to understand what the agings look like and what does that relate to. Additionally, you'll notice they had some accrued commissions and accrued accounting. These are what I would do in this instance. I ask questions by simply just writing alongside the GL account in the Excel document about what these related to. When I see something like accrued commissions, I immediately think, there may be salespeople who are owed commissions, which is often a critical item to consider at the time of close. Sales commissions and unpaid liabilities is a risk, and it typically falls in the debt-like piece of a financial diligence engagement. So these are kind of the pieces you would ask. One last thing on accounts receivable. Typically, the way you approach this is you obtain accounts receivable aging schedule for the last few years at the stub periods. The stub periods are AR as of 12/31/23, 22, 21, and then as of November 27th, 2024, you want to look out for things like significantly aged receivables greater than 90 days, um, and other items like that. Working capital evaluation. This is another big piece. In the 10,000 foot view of what some of the challenges with these deals are, more often than not, deals die during the working capital negotiation, whether it's due to the sellers and buyers not understanding what a proper working capital evaluation looks like. This often is the biggest deal killer I see in these small to medium deals. My best practice is when you're drafting your LOI, set clear expectations of what working capital should look like. Is working capital included in your deal at all? If it is, what is it comprised of? Is it really AR and AP? Do you want to have the whole balance sheet? Is it going to be a cash-free, debt-free basis? You as a buyer, and I imagine most of this call is buyers, once you identify what you think is valuable and what you would like in your deal, be very clear with the owner where this working capital explanation is actually included in the LOI. Ask them if they understand what it means, and then discuss some of the ramifications of what that actually looks like during the transaction. More often than not, these sellers will not understand some of the ramifications. And if you don't properly explain this, the risk is you may be very familiar with this terminology, but these deals will die because sellers don't understand, and they often will become very guarded at the idea of giving you working capital. So just ensure that there's a proper dialogue about this is really my only recommendation as you kind of move into this next phase. Yeah, so here's a working capital live deal kind of story and where it actually moves the needle in terms of real dollars. So there was a deal I recently did where the plan was the buyer and seller agreed 500,000 was a fair and appropriate working capital amount to be included at the time of close. Based on the nature of the business, in this case, it was a display and materials company for some of the large beauty companies in the world. These were very cash intensive businesses. They had significant costs to produce, these display cases, and then they had large accounts receivable due to some of the larger sales, which were paid on a 60-day, 90-day time frame. Based on the size of the business, I had some concerns and challenges about whether or not this working capital number was correct. So by doing a working capital analysis, we were able to determine that in reality, it should have been much closer to about 900,000 based on historical figures, as well as where the business was going in the next 12 to 24 months. Ultimately, I determined that a proper net working capital peg was about $900,000. And this was established, through a few things. It was identifying what the company's ongoing commitments were, estimating sales and costs, and then really looking at analyzing the cash flow of the business on a month by month basis at the time of expected closing. Working capital is very subjective, but this was kind of how I approach it during financial due diligence. So I recommend that either you kind of perform the same analysis, or you bring someone on who can satisfy, this analysis to get you the answer you need. Fortunately, based on the work and review, we did agree on about a $900,000 net working capital amount to be delivered at the time of close. So right there, the LOI went from 500 to 900 without materially changing the deal terms. Without this ongoing discussion between buyers and sellers, it's very likely the deal may not have closed due to some of the tensions around this. In reality, the seller was going to have to deliver 400 or 500,000 more of AR in order to meet this requirement. But the most important piece is, if the buyer settled on the 500,000, it's very likely there would have been a cash crunch, and they would have needed some sort of line of credit or um, cash injection to keep the business ongoing during the operations. So that's kind of how working capital impacts your deal as financial due diligence. Just wanted to call that out. Next slide, please. Yeah, so we're going to be doing a further deep dive on walking through a real life example of working capital. So if you want to join me next time, you can scan the QR code. Or we can do next slide. So being respectful of time, we're going to move on and kind of tick through the other three pieces and then save some time for questions. So the next one is, how do we conduct a quality of earnings EBITDA analysis? That's bucket 3. So we've done financial detail review. We have done a balance sheet detail review. How do we take our findings and we get to an adjusted EBITDA? We want to begin to identify recurring revenue, normalized revenue and expenses from one-time revenues or one-time expenses that seem abnormal. Things like a one-time large expense, a one-time true-up of expenses at year end due to how they close their books on a year-by-year basis. And this is really a culmination of your findings during the income statement and balance sheet review. You can evaluate margins to ensure that there's profitability, and then you adjust accordingly. All of these items are to identify risks and really spot abnormal items in the earnings to show what does a clear view of earnings look like going forward. Next slide. So here is a real deal example of what a EBITDA analysis looks like. There's a lot to unpack, so I'll call out a few items. The EBITDA reported is effectively a culmination of reported financial information. Think income statement, costs, net income, plus interest, taxes, depreciation, and amortization. That is sort of the Bible, as I like to call it, of what is your reported EBITDA. From there, we really conduct our EBITDA analysis, and our output is in the form of due diligence adjustments. These due diligence adjustments can vary based on industry, who's performing it, etc. But the objective is to identify certain abnormalities of one-time items and either increase EBITDA or decrease EBITDA accordingly. To double click on some of these items, if we look at the grid, we will see things like one-time owner bonus. This relates to the owner giving himself a one-time bonus of $146,000 in 2023. This was discovered during the income statement review. This was originally flagged when I was looking at the P&L. It didn't say owner bonus. It just had a $146,000 expense item in miscellaneous expenses. When I asked him what the details of it were, he said, oh, it was a bonus I gave to myself at the end of 2023 for tax reasons, to basically decrease the net income of the company. Financial due diligence is not a tax audit. This is to understand what the normalized earnings look like of the company. So in reality, this was a discretionary bonus which lowered earnings in 2023. Therefore, this needs to be added back and therefore increasing your EBITDA due to the discretionary nature of it. And it's not critical to the business. So that's what that looks like. There's other ones, things like one-time professional fees, automobile and truck expenses, which were personal and owner related, pension expense, which was owner related. Due diligence adjustment A2 was actually out of period refunds. So the company received refunds related to periods before that where they recorded revenues. So this was just adjusting the financial data accordingly. These due diligence adjustments can be quite complicated. So really, it's understanding where you can find this information and how it applies to your deal optics. A lot of the information you could find is going to be in this general ledger detail review, double clicking on certain items from your income statement and balance sheet review, digging up the general ledger support, and then asking the owners what these relate to. Based on their responses, asking yourself the question, is this a normal thing that's going to occur going forward? Or if it's not, how does that impact the financials? Next slide, please. So this is a proof of cash. It's also referred to as a proof of revenue. These items, effectively, this analysis, the purpose of it is to use the bank statements and based on the cash receipts and the cash disbursements, prove out reported revenues and expenses. In this case, the proof of revenue or proof of cash took the cash receipts in total across the company's operating account. And, this item that says less non-revenue items. So if there were things such as bank transfers, intercompany transfers across different accounts, these are non-operating items that shouldn't be considered revenue. So that's what this less is. If you look at the less non-revenue items for 6 million, from there, you have total adjusted cash receipts. Effectively, what this means is what are your expected adjusted cash receipts and revenue the company earns that was actually operational in nature. From there, you compare what you think the adjusted cash receipts revenues of the company should be to what it's recorded in QuickBooks. That is revenue as reported. There are certain items you need to consider either increasing or decreasing from your reported revenues in QuickBooks. You'll notice that there were accounts receivable items Whether accounts receivable is increased or decreased needs to be reflected in this grid. Um, there may be other items in reported revenues that don't correlate to business operations and journal entries and how they're accounting. A lot of these factors are in the balance sheet. Um, Ultimately, the objective is if you get this variance within 2%, it's safe to say that this procedure is kind of satisfied completely. Um, Anything higher than 2 to 3% on a revenue side and 5% on an expense side needs to be investigated further. That's best practice. So, what are the benefits of effective due diligence? Ultimately, it sets the foundation for a successful acquisition. More often, due diligence is based on a adjusted earnings of what the cash flow is going to look like for you as a buyer going forward. If you don't understand the clear view of normalized earnings of a company, you can't properly assess if the company can afford to pay, potentially an SBA debt payment on a monthly basis for 10 years. Um, Due diligence ensures a fair valuation of the business. Uh, I often see LOIs include the purchase price will be based on an adjusted EBITDA, which will be determined during due diligence. It can be based on an average period of, say, 1 to 3 years. I've seen other items such as calling out a multiple of EBITDA they will use. Ultimately, the benefits relate to minimizing your risks, uncovering hidden issues which may not have revealed themselves until after you close the deal. And ultimately, there's potential deal killers during this procedure, which can materially save yourself as a buyer before you kind of sign this purchase agreement. So that there's a lot to unpack with this. I would say that it's always best practice to partner with someone who's familiar with due diligence in the space, and because you can really leverage a lot from a financial, operational, and post-closing game plan during these 1 to 90 days. So when you conclude a due diligence engagement, where do you go from there? Typically, it's in the middle of your LOI timeframe. If it's 90 days, it may be done earlier in the process. You need to take your due diligence findings and see how it relates to the overall deal structure. If there were significant findings in due diligence, do you potentially need to adjust your purchase price terms based on findings? I will say adjusting terms because you may be able to keep the same total purchase price, but if there are certain findings that materially impact the total value of the business, you could restructure the agreement in the form of a higher seller note, um, placing other earnouts and contingencies depending on what type of deal you're doing. There's a lot of different ways to structure agreements. I've held other webinars specifically on that, so feel free to check out those. But due diligence arms you with information to better assess whether or not this deal makes sense for you.